Hello, fellow RoboCapitals. Hope you're well. I am here with my good buddy, Kenny McElroy, and we are going to talk about all things real estate for 2025. This is going to be incredible. There's a lot of unknowns, a lot of volatility. And Kenny, there's some things that are going on in the real estate market right now with residential, multifamily and single family that are probably unprecedented. I mean, things that we've never seen in the real estate market. And it's not just with Trump tariffs, it's with a lot of different things. So let's start by going over kind of how you see 2025 playing out and then what you're seeing with all the boots on the ground intel that you have with the real estate market right now.
Well, George, I'm going to steal your line. There are no certainties, only probabilities.
Yeah, right.
But I'll tell you what, it actually worked really well for this because the way I see it right now is we have the prices of single family homes have come down a little bit, specifically in certain markets with some of the movement around, specifically up in the Northeast with Doge and all that. We're starting.
Washington D.C. home prices down by 50%, right?
Yep, quite a bit. Yep, and that and I always tell people, like real estate doesn't do really well if there's no people. So you know what I mean? So as people move around, I mean, people forget that it's such a basic thing, but no renters, no buyers, nobody walking in and buying food, anything, whatever it is, whatever you own, whatever hard asset, whatever category, if there's storage or industrial or office or multifamily or single family, it doesn't really matter. The migration of people are super important, and of course supply and demand. So what we have is we have so many things that we can talk about today. But the one thing that's been really interesting is the migration continues from the pandemic on for lots of different reasons. We had the hurricanes, we had the fires out in California. We now have the federal, Doge, worker disruption, let's call it. And so that's all creating issues, both on the rental and on the multifamily side.
But it's the migration, Kenny. Is it the same migration as we saw during the cerveza sickness, or is it now different?
Very different. Yeah. In fact, it's as you know, there's a real strong work from home that back then, and now it's being retracted, right? So that's I don't know. A lot of people thought it was going to be kind of somewhere in the middle, but I think a lot of employers have now are realizing that it's hard to build a culture when people are at home, and we're doing it over Zoom. I'm not saying that people can't work from home. I'm just saying that what we originally thought would be here is kind of moving back. So that actually has been good for office, even though office is in real trouble. And it's been moving people back into areas that, they had moved away from. So there's that, of course. But then the one big issue that I think people that need to be clear on is interest rates. When they're really, really low, people are building houses, they're building multifamily, they're building other things. When they went up a couple of years ago, people pulled back. So what you're seeing right now hit the market are things that were started, a year to 2 to 3 years ago. And so as you say, it's the pig through the python. So we're starting to see these units hit the market. Oddly enough, it's kind of needed for the renters, because the renters, they've been screwed. The lack of supply has driven real high rent growth in the past, and now we're starting to see some of that stability. On the other side of that, inflation's crushing people. Airbnbs, or if anybody bought in the last 3 or 4 or 5 years, they have a very, very disrupted time. If they have stability from the time before that, it's going to be a lot better for them.
Now, what you're talking about is single family. So if they bought a single family home within the last couple of years, they're flat, maybe up slightly, or maybe even potentially.
Yeah, potentially. And of course,
they bought an overpaid for an Airbnb based on short-term cash flow, and now all of a sudden their occupancy rate is 20%. Then that could be some supply that's coming onto the market. that could be impacting the prices for the owner occupants.
You got it. Yeah, and I want to be clear. Like back when you and I were growing up, we never talked about investors in single family.
Yeah, that's a good point.
Yeah,
Very good point. Like that wasn't even a thing back then.
Correct. And so, so when you talk about the rising and falling of single family in the past, like with me, like I built a home and in 2008, George, like at the absolute worst time, right?
Yeah.
And after I was done building it, the price of the home went down, but it didn't matter because I stayed in. I raised my family in it. I wasn't even really paying attention to the equity in it, even though I knew it was down. And so I think that you have to look at the use. And so if somebody has bought a home and they're living in it and they're working somewhere, it's possible it goes up and down, but it doesn't really matter unless they're trying to get out of it. Now, if they're renting it or Airbnb-ing it, very different, right? Very different, because that market is very disrupted.
Yeah. So in other words, that if you're just living in it and you're there because of the school district, because your kids are, play football or whatever it is, and you're planning on staying there for the next 15 years, you don't really check the price. You're not checking Zillow every day. It doesn't matter. But if the only way that you are able to own that property is with the cash flow from the rent from Airbnb, and that gets cut in half, now all of a sudden you're cash flow negative.
That's right.
The mortgage, and you're in a position where you're let's say a motivated seller. So we're seeing that in markets with the single family, but you've been seeing that quite extensively in the multifamily space. And I think when you combine these two, that's where we're seeing things that I don't know. I mean, you've been in this business a long time, but I'm sure there's things playing out right now in 2025 that you've probably never seen.
Yeah. Well, I'll tell you what's been the most interesting is there's a lot of new money that came into the space, call it 5, 6, 7 years ago. People came in, they were syndicating, they were buying stuff, didn't matter what, where, and they did it with this floating rate debt.
Right.
And what happened was it was all based on the property being better than it was yesterday, right? And that's the whole story. That's what the banks lend on. What happened is when interest rates went up in reaction to the inflation, then all of a sudden the commercial market got repriced. And I'm talking about office, retail, multifamily. If you doesn't matter what it is.
Yeah.
Whatever it is that you're going to buy today versus 2-3 years ago, the interest rate's higher today. And therefore a seller's going to pay less, period. That's how it works. So, because we're always solving the cash flow, and cash flow is going to be less if our mortgage payment's higher. So it doesn't really matter if it's $1 million commercial corner building, that's still $1 million. The seller is still going to want $1 million, but today they might only get 800, 850, 750 for it because of the price of the debt is more. Because
the price of the debt, Kenny, because you're solving the cash flow, and that isn't just rents minus mortgage. It's
correct.
Insurance,
right.
It's maintenance, it's your labor costs, it's all of these things. So even let's just assume for a moment that those people that got over their skis had a fixed rate mortgage. Well, they still could be screwed if all their other costs to own that property are increasing, cutting down those cash flows. And then a potential buyer is going to look at that, and then they're going to quote unquote solve the cash flow. And that's where they're going to get a whole hell of a lot less than they maybe put in to build it or buy it to begin with, assuming they did it over the last couple of years. So it's almost like the same thing that played out in the single family space prior to the GFC or during the GFC played out and is playing out in the multifamily space right now.
Yeah, and I'll tell you, there's a really, really good website that came out of bankrate.com, just bankrate.com. They did a study not long ago that said just to own a single family, just own, not mortgage, it's 18 grand. That's the average. So you think about, it's $1,500 a month right now just to own something. Not including a mortgage free. So now you start to overlay that with rents next door or in the neighborhood over, then you layer on, of course, the mortgage, especially today with the higher rates. The delta between a rent and a mortgage has not been any higher. right now as a result.
And in your career, you started doing this, in the late
in the
80s?
Yeah, in the 80s. Yeah, right out of college.
Have you ever seen prices, not forget the mortgage, all the other inputs to owning a single family home or multifamily? Have you ever seen them go up as fast as we've seen over the past 4 or 5 years?
I personally haven't. It's been shocking. Like I'll just give a very, very real examples. Our company, we have about 10,000 apartments. So we have 10,000 units all over Texas, Oklahoma, Nevada, Arizona specifically. So, those are the markets we in, those are the markets we track. Our insurance bill went up 34%. So in the millions more per. Now that's just the exact same properties with really, really low losses.
Right.
So you can imagine just all of a sudden here, hey, like in order to renew, and we're seeing this at a small level with single family houses. We're seeing it with autos. People all over the place are experiencing these doubling of insurance policies. In some cases, you can't even get it. Our friend Travis in the collective, our mastermind that we do, he had a hurricane. The sand came into his home in Florida, and he just can't insure it. He just literally, it's all just cash. And so there's, people are dealing with no insurance. Certainly this was the case in California. I have a really good friend. He was at my house the other day and he lost a home in Malibu. And I said, oh my gosh, I'm sorry to hear that, Jay. And he said, yeah. I go, what's the rebuild? The rebuild's about 10, but my insurance caps at 3. So
10 million.
He's got to come out of pocket 7 to replace it, and he's going to do it. But so you got these other kind of things. Just around insurance, by the way. We're starting to see here in Arizona. I live in Scottsdale. We're starting to see people over in our market because of what happened with the fires over there. And they're considering they're either selling, even if their house wasn't affected. They're, if they were spared, they're like, do I really want to be here when, my neighbors, homes were burned or whatever it is. So going
back to your buddy. I'm curious because 7 million out of pocket, and it's not like he can just rebuild tomorrow. I'm sure.
Oh no, that's a whole other topic. That's what I said to him. I go, how are you going to find a contractor? He goes, that's the next step. He goes, it's
get licensed from, I don't know if he's close to the ocean or whatever that agency was that he has to get permission. I mean, it's going to take him 10 years plus 7 million out of, and who knows what the price will be.
Correct.
He actually gets the permits. It's 7 million now. It could be 15 million with the cost of labor and supplies, lumber going up. So is he going to rebuild, or is he like, well, I'm just going to see how it plays out over the next 6 months and then make it?
Nope. He told me he was going to. Now, obviously, I've been to this house. It's really, really nice. And that's his goal. And his wife was with him and they were chatting about it. And he's like, yeah, it's a massive bummer, but it's an incredible lot. They love it over there. So, and he lives in Paradise Valley, Arizona now.
And then what does he do about his insurance moving forward? I mean, will they even insure it?
They may or may not. It'll be very interesting. He's in the real estate game on more of the triple net stuff like Walgreens, CVS. And he's owned shopping centers and stuff. So he's not foreign to any of this stuff. So my guess is he'll figure it out.
Yeah, and obviously for him, losing a house, it's obvious not pocket change. Dropping 7 million, and then having an asset that's, let's just say, worth 10 million that you can't insure. So let's just say you do get another fire and it wipes it out. It's not like that's going to change his lifestyle. Right. He's got plenty of money. But for most people, even in California, that house is maybe 100% of their net worth. And they just can't, and let's scale it down a little bit and say instead of 10 million, it's $1 million property, and they got to come out of pocket, let's say 700,000. And where are they going to get the 700,000? And if they do, they rebuild, that's their net worth. They're not going to be able to insure it. Are they really going to want to roll the dice? The answer is probably not. And that's where you're seeing that big bump in Scottsdale.
Correct. Yeah. And I'll tell you what was really interesting to me. I was like, wow, it's pretty quick. All these people moving over here so fast. And I was talking to some local realtors and a buddy of mine who lives in Arcadia, where Arcadia is. And he said that there were 5 families from California that, checked into his school. Now he's got young kids. And I said, well, that makes a lot of sense. He said, yeah, because their schools are gone. And I said, "Oh, okay, I get it now." So what they're doing is they're coming over into Scottsdale, Phoenix, and probably other places, and they're just trying to get their kids back in school. So that's something that nobody's really discussing, but that does make sense of why people would move.
Wow, California's. I mean, if California was a stock, you would want to go short with leverage.
Yeah, yeah.
Cow, give me the triple short California ETF. Man, but getting back to the inflation, I think that's a key component of what could drive supply moving forward. We're seeing it drive supply in multifamily because you're picking up a lot of these deals from the people that didn't really do the math right. But I think in 2025, maybe in 2026, we're seeing people's purchasing power decrease. The wages for most people just have not kept up with consumer prices. And even if they do have that fixed rate mortgage, it's going to get to a point where they can't afford to keep that house, and maybe they borrow to keep it, but at some point they're going to have to sell it. And the good news is they'll probably have some equity. So it's not like they're taking a hit, but what does that do to supply and what does that do to prices? Because if prices aren't going up and supply is at an all-time low, that means that demand is also at an all-time low.
Yeah.
And so what's happening with the supply side on single family, and then what's happening with the supply side that you're seeing right now with multifamily and maybe some of these deals that you're picking up?
So on single family, what's interesting is the home builders, believe it or not, have actually still kind of moved along. So, and what we're seeing there, this is very, very interesting. I don't know if this is the next shoe to drop or not, but the interest rates are obviously what kills somebody buying something, let's say. So if you're a home builder and you built 100 homes in a subdivision, what you're doing right now is you're doing buy downs. So you're buying down people's rate, and it's essentially they're financing their own lower rate, right?
Yeah, it's an accounting gimmick. And the bottom line is if you're a home builder and you're going to sell all those 100 homes for 500,000, now what you're doing is you're selling for 450 and you're just decreasing your margin just to give that 50,000 to the buyer in the form of a reduced interest rate.
Correct. Yeah. And so what it's doing is it's getting people into these houses. It'll be interesting because that could be a year or two, right? It just gives them like temporary relief. And then that's like some huge jump, right? After it corrects. But that's been a very interesting thing. That the supply of homes hitting the market is still historically low. It's somewhere in the 50. I haven't looked recently, but it's like 55% of the average. So
is that with new builds, Kenny, or is that with
that's everything? Yeah, that's the MLS.
Okay.
Yeah, and so it's still historically low, but we are starting to see days on market longer. We are starting to see deals. We're not, but let's don't forget that what we just came from was not rational. It was not, when multiple people are trying to bid on something and bid it up over listing, that's not a balanced market at all. So I would say that it's moving toward a balanced market. Days on market is normal at 4 to 6 months. That's normal. Okay. So and people were just used to a month or two, and so I think we're going back to normalcy on the single family side. But I do think what's going to be very interesting to see is what Trump does. The Trump policies are going to determine a lot. So if he does something like Clinton did or Bush did, basically that said, we're trying to get people into home ownership, which he could do, and there's a lot of pressure around that, then you could see some super creative things like 40-year mortgages or releasing federal land or, all these other things that he's talked about. Creative. So it'll be really, really very, very interesting. And obviously we need affordable homes. As you know, you met my two kids. They're in their 20s. There's no possible way they can, save. They have to save $100,000 basically to be able to buy a home. Think about that. That's so much money for a young person. Obviously, there's other ways to have a lot less if you're a veteran and all these other creative programs. But at the end of the day, it's super unaffordable now. On the multifamily side, we have like a window, like an 18-month to 24-month window. And I just want to point out, as you know, I've been kind of on the shelf on the acquisition side. And now we're very aggressively looking at assets and trying to buy stuff. And we'll do about 500 million in acquisitions and by the end of April. And we're just super aggressive right now because what's happening is there's disruption. If you're a seller or you're a lender, your prices are 30-40% less than they were. People are struggling with the high operating costs.
I want to be very clear there, Kenny, because when you say that that you're aggressive, I think a lot of people will take that as though there's this huge bull market in multifamily,
no.
and we've got nothing to worry about. And it's quite the opposite.
It's horrible.
You're getting aggressive, and that means that someone else who you're buying from, it's not like they're making money on the property, flipping it to you. They're taking a massive haircut. And I know there was one deal that the guy paid like $325,000 per door to build it like 2 years ago. And then he got in some serious trouble because of the interest rate, because all of his costs went up and his rents didn't go up as much as he thought they would. And then you came in and bought it for like $225 a door, like 100,000, 75,000 less per door. And someone has got to take that hit. That blows a hole in someone's balance sheet. So when you say you're being aggressive, that's because other people are losing a hell of a lot of money.
Yeah, that's a good point. Like anything, whether it's buying an old car and fixing it up, or buying an old house and fixing it up, or buying, something that corrects, that's the time you want to buy. You want to buy when there's disruption. There's disruption. Interest rates are high. Operating costs are high. Occupancy is low. Vacancy is high. Concessions are high. We're starting to see defaults. We're starting to see all kinds of stuff. That's when the professionals jump in and start to clean up these messes for other people.
Yeah. But again, to be clear, you're not buying from people that have equity.
No,
you're buying from guys who, like that old car, that guy, the guy that sold that to you probably owns the car outright. Or the old house, the old lady probably bought it for $5,000, 50 years ago or whatever it was. So they've got some positive equity in there. But the guys that you are buying from, they have negative equity. They paid, let's say, 10 million, and they're selling it to you for 5.
Right. Well, I'll tell you what, it's a really, really good point. When we just looked at an attorney sent us 6 assets, 2 in Texas, 4 in Arizona last week, and we're underwriting them all right now on behalf of another group, and we know who the other group is. But essentially, the only thing we would ever do is buy them for the debt. Period. We don't even consider the equity.
All right.
And so now, in some cases, believe it or not, they had a little bit of equity, but in a lot of cases, it was well below the debt. So it was a mixed bag with what we saw. But at the end of the day, you have to size it based on today's math. So today's math is, and you said it earlier, it's today's operating expenses, today's rents, and today's mortgage payment. That's it. Those are the things. And then we don't care anything else. We don't care what the financials say. We don't care what they've been running it like. We don't care what the mortgage is. You have to look at it that way first. And then you negotiate from there back to a position that, makes your investors money.
Yeah. And I think the point is that's been your MO for the last 30 years.
Yeah.
Let's say other people that don't have your experience, and these are the guys that you're buying from, they don't do that. What they do is they look at a deal and then they try to create all these pro forma numbers, and they project out into the future and say, oh, well, yeah, I'm getting $1,000 a door for rent right now, but next year I'm going to go ahead and get $1,500. So they write the deal based on 1,500 as opposed to the 1,000 that they're getting. And then if they don't get the 1,500, now all of a sudden they got a big problem. And the reason I'm harping on this so much, Kenny, is because that's going to go back to the banks. And
yeah, I'll give you a great example that just nails that home. So Ross and I decided to sell a property in Houston, Texas that we first went and we renovated 4 units and we're trying to push rents and said, let's renovate some units and see if we can rent them for more. And we spent about 10 grand per unit. So we spent about 40 grand to try to push rents. And after about 6 months, we were like, okay, like we're at market. We're not going to see any rent growth or anything like that. So we decided to list it. And we listed it and went out with a big brokerage, national brokerage company. Well, I happen to be on the list of the person who we actually are selling it to. So we actually went into escrow. They put money into.
So they pitched your deal to you.
Yeah. So I get the package. I get the package on a deal I own. Yeah. And I open it up and I start laughing. I chuckle because it's exactly what you said. Well, the operator sucks, which is me, the owner, there's all this deferred maintenance, which is us, and by the way, the property was not that old. And it was really, really well kept. And we had already, of course, I already told you, we already tried to see. Now
it's all BS. It's all BS.
So I shot it to Ross and I go, let's check this out. Like, this is how you raise money right here. You basically can put anything you want on any business plan at any time and raise money. And guess what? They closed it. They sold it. We sold it to them and they closed. Maybe I missed something. I don't know, but I'll just tell you that was a great example of being the seller of something and then getting pitched to invest in it.
Yeah. Now that buyer's holding the bag.
Yep.
All right. So now let's try to think through. We know kind of where we are now with single family. We're kind of getting more at an equilibrium point. With multifamily, we're still kind of in that decline phase where the guys like you are coming in and trying to, let's just say, bottom feed, for lack of a better word. I get some good deals from these guys that didn't have that experience, that got overly optimistic. But now moving forward with 2025 and into possibly 2026, let's try to figure out what's going to happen with interest rates, what might happen with the economy, and therefore how that would play into residential and how that would play into multifamily. And then I think what's interesting about residential is it's not just how will the economy and interest rates play into residential, but how could residential play into the economy?
Yeah.
You know what I mean by that? Because so much of today's purchasing power in the United States is built on asset prices. And obviously the average Joe and Jane, they don't worry about multifamily. Not too many people own apartment buildings. But a lot of the purchasing power, a lot of the aggregate demand that we've seen in the economy over the last 2 years has been a result of the S&P being at all-time highs and housing prices being at these nosebleed levels. So it's a circular type of argument, or a circular type of thought experiment, right?
Yeah.
Where it's so anyway, let's start with interest rates and the economy, and then we'll try to go to residential. Okay. And
I just want to add one more thing, George, which I'm sure you've thought through. When we talk about, let's say a single family home, what we're really talking about is a realtor, a title company, a mortgage person, a contractor, a landscaper. There's so many pieces for one, because I have friends in all those spaces that are getting crushed right now.
The jobs you're talking about. There's that one real estate transaction goes away, then all those jobs go away as well.
Ripple effect for sure.
Okay, so I think that we're likely, I guess my base case, and there's so many unknowns with everything that's happening politically and geopolitically, and with the new Treasury, with the Fed. But let's just assume for a moment we're at 4 point. We just, I think, got the 4.3 handle on the 10-year Treasury. So let's just assume for a moment that we fast forward to the end of 2025, and the 10-year Treasury is trading at, what would be my base case? I could see it at 3.5 pretty easy. So let's say it goes down to 3.5. And then let's say that would mean, and let's just say that we have a balance sheet recession. So we have something similar to .com, but not the 50% down. Let's just say that the stock market at the end of 2025 is 25% lower than it is today. I don't think that's outrageous. And let's say that home prices in nominal terms are 5% lower, and we've got a 3.5 10-year treasury yield. So where would that, and then let's just say that the unemployment, because we go up in a recession, let's just say the unemployment goes from 4% up to 5%. So first and foremost, what does that do to residential? I would say that you're likely to see supply increase. And that's maybe what brings you to that 5% down in housing. What do you think?
Yeah. Well, I want to be, the 10-year was at that price in September of last year. So
Right.
what, 4 or 5 months ago. So I think because now I was just there. I felt like I was just there, like stuff that we were looking at in Q4 2024 was at 3.5, 3.6. And so, now it's gone up and it's been harder. Right. So for me personally, if it just comes back, it's like, oh, great. Now I'm just back to like, I'm just still treading water to where I was like in Q4.
But all your other expenses are a lot higher still.
Oh yeah, that's
like
for
they're
sure.
Going back down to where they were 6 months ago
Correct.
or a year ago.
Yeah. They're not going back down either. So, yes. So yes, I do think on the commercial side of the house, George, I don't see much movement personally with the 10-year going down. You got to remember all this stuff happened when it was basically 0 or 1, or, and rates were the imputed interest rate was 3.5%, 4%. And so.
Okay, so let me stop right there because that's a good point, Kenny. So what you're saying, and obviously, guys, we're trying to think this through out loud here, is in order for it to move the needle, meaning the 10-year treasury, it ain't going down to 3.5. It would have to go down to 1.5 or 2, something like that. It would have to make a dramatic
really make a difference. Yep, on commercial for sure.
Yeah. Or on the flip side of that, the economy would really have to boom. I mean, we'd have to have, real GDP going back up to 4, 5, 6%, something like that. Yeah. And then the incomes theoretically would go up to a point where the people could once again afford the mortgage payment because, even though the interest rate is still, let's just say 4.3 or 3.5 or 4%, their incomes have gone up so much that it's still taking a lower percentage of their overall paycheck, and they can afford to make that payment every single month. But the thing there, though, is if we do get the 10-year treasury yield trading at 2%, I can assure you the economy.
Another bubble.
The economy is going to be in bad shape. The unemployment rate then is probably going to be, 5.5, 6%, in which case, even if people can get a loan, fewer people are going to qualify.
Yes, I completely agree with all that. Yeah, that's exactly right. And so, that low 10-year is what created the bubble we're in. And now, right now, and you said this really nicely with, you can have inflation and deflation at the same time. And so that's what we saw with multifamily. Right. So what we saw it inflating, and now there's a hole and it's deflated. And, now it costs more money to operate them, right? So that's actually another thing. And we're starting to see higher vacancy, concessions and stuff because of the supply that's hitting from when interest rates were low, a couple of years ago. Because when I put a shovel in the dirt on anything, anywhere, or anyone does, it's a good year and a half before you even open the clubhouse, and then it's a year and a half to lease it. So the thing's 3 years construction, and then probably a good 1 or 2 before. So these are 4 and 5 year projects, these construction deals.
Yeah. Okay. So main takeaway there is for home prices to continue to go up at a clip like most people are accustomed to, we would have to have some serious economic growth. If we don't get the economic growth, then it's likely that, let's just assume interest rates say close to where they are today, or they don't go down enough to really make an impact. Then we should assume that the trend we have seen over the past, let's say, year or 6 months continues, which is to say overall kind of flat to down. And in some markets, we're getting, a little decline there in nominal prices, and in other markets, maybe a slight increase, but the risk would be to the downside. Whereas then the other third scenario would be if you get those interest rates to fall because of recession, then you should expect to see prices go down pretty substantially, because then you're going to have a big supply rush, because people don't have a choice. Even though they got that fixed rate mortgage, they have to sell. It's not an option.
Yeah, and the good news this time around, as opposed to 2008, which I survived and went through, and you did too. I think that now there's a lot of trapped equity sitting in these homes, right? That's the one nice thing. I mean, if you're a homeowner and you've got a bunch of money sitting in equity, even if it's less, you can exit and you have better choices this time around. Well, if you're on the renter side, I think you're in a little bit of trouble, because what you have is a maybe an 18-month window of concessions and flat rents. We put a deal in escrow 2 weeks ago, another one, nice 280 unit project, really, really beautiful project. And the owner is one of the largest pension funds in Canada. And we were on the phone with him, and he said, walk me through how you underwrote the income and expenses. And our acquisition guy said, well, what we did is we anticipated flat rents with concessions for the next 2 years. And he's like, good, because that's what I agree with too. And that's how we underwrote the deal. And then, of course, we also had expenses going up. So we had flat rent, even negative, and expenses going up. And that's the right way to take a look at, the next 18 to 24 months. And then, because if you're saying, oh, we're going to have this rent growth and we're going to cut all the expenses, you're just going to, first of all, you wouldn't be on a conversation like that with this particular buyer. But, that's actually what everyone did in the last few years. And
they're starting. That's good news for renters.
Yep.
Looking at just their direct rent payment. Where it might be bad news is that means that more people are taking a haircut, more blowing a hole in the balance sheet. That makes the banks less stable, which could lead to unemployment. So if you are or higher unemployment, if you are a renter that manages to keep your job, then 2025, 2026 should be a lot easier for you than 2023 and 2024.
Yeah, that's right. I think that's probably true. The thing is at the level I'm at with the money that's flowing in, both on the debt and the equity, it's really managed money with accredited institution, private equity, family office money. So it's not like at the Main Street level. And so, like in that particular case, in fact, in the case that the one that you actually walked with me and you saw the one that we bought in Las Vegas, that was a life company. So the life company took a huge hit financially.
Life insurance, right?
A life insurance company, yeah. So they took a huge hit on that when we bought it from where they were financially in it. But, if you take a look at them, it's such a small little thing in their big picture. It doesn't even hardly show up. So when like on this particular case on this pension that, we're negotiating with right now, they're going to have a similar situation. But if you're the largest pension or one of them in the country, it's gonna be a hit. It'll be 10, 20, 30, $40 million hit, let's say, but it's gonna be a rounding error on their balance sheet now. And so I just want to point that out. A lot of these commercial office buildings and a lot of these big industrial and a lot of these big multifamilies, it really is at the Wall Street family office institutional level, and so, but it is other people's money. Don't forget, it's managed money, and but if it's diverse. So while it's a hit, it's not like, oh, I've got 3 projects and I just lost a third of my net worth on this one. In most cases, it's not like that.
Yeah, but it sure as hell could be.
Oh,
Because
yeah.
the reason I say that, Kenny, is because a lot of these pension funds, they think they're diversified because
I know.
they've got 25% in real estate. They've got 25% or maybe 50% in long equities, stocks. They might have 10, 15% in bonds, and then they think, oh, well, look at this. We're completely diversified. We've got nothing to worry about. Well, actually, you do have something to worry about because the whole economy is built on asset prices.
Yep.
So if the S&P 500, let's say, goes down by 25 or 30%, now that's blowing a significant hole, let's say, in their balance sheet because they're 50% allocated to stocks. And then, you've got the saving grace of the bonds potentially, but now with 75% of your portfolio, now you're taking, you're losing money. You're losing money with the S&P 500, and you're losing money with that commercial property, that multifamily property that you're having to sell to Ken McElroy at a 45% loss. So they're fine so long as the stock market stays up.
Yeah, that's
stock
right.
market doesn't stay up, then we got a big problem, and then they can't pay their liabilities, which are the pensioners. And then how does that impact aggregate demand? So I'm not saying that that's going to play out, but you've got to understand the fragility of the situation.
Yeah, it does depend on their allocations for sure. And by the way, that's just that example. There are plenty of examples of people that were raising money at $25,000, $50,000, $100,000 and investing in deals. And those are the ones that are cracking right now that we're also seeing.
What do you mean raising money at $50,000 or $100,000?
Well, in the last 3 or 4 years, we saw a lot of syndicators raising capital, right? So, whatever it was, and they could have hundreds of people in one deal, all investing these small amounts.
I see. Yes, and that could be a big problem.
Yeah, it already is. I already know of multiple scenarios where that money's gone today. If they have to sell, the loan matures, or what, they run out of money or whatever. So 2025 is going to be an interesting time for that type of a syndicator, because if they don't have the cash to, or the lender's not working with them, or let's say they don't have any equity sitting in there in that property, then the lender's just going to take that back.
Yeah. So what you're saying there too is it's a totally different ballgame when you're doing a multifamily deal, and let's say you have 10 investors that are all worth 100 million each, as opposed to whatever, let's just say 100 investors or 1,000 investors that their net worth is 150,000 each.
Correct.
That's a different dynamic there. Those are different conversations on the phone.
Yeah, but it's interesting because you could be looking at let's say you're driving down a street and you might see 2 properties and they might be identical, and one could be completely Wall Street institutional life insurance, and the next one could be that second scenario with 500 people invested at 50 grand each.
I see. And the pressure on that latter syndicator is going to be far greater.
Yeah, because the fundamentals of the market are doing the same thing to both properties. The interest rates are up and the expenses are up, and you're fighting for occupancy. You're probably fighting for the same tenant. Let's say even they go to yours and they go to the one next door. All the market forces are equal, and so the holding power of the actual equity itself or the debt is going to kind of drive what happens to the asset. And so that's what we're starting to see play out.
And you're saying that the Wall Street deal, the holding power is greater because it's just a much lower, almost an insignificant percentage of the overall net worth.
Right. Yeah. And also, yes, they could stroke a check. They don't want to stroke a check. It comes with pain, of course. Whereas the person who put together a deal with 500 people, can you imagine if you have to do a cash call? Like, hey, we need 10 grand from everyone. And those are real things that have been going on for the last couple of years. So we're starting to see that.
Did you see more of those type of syndicators over the last, let's say, 4 or 5 years?
Oh yeah,
what you saw in like the 20.
Yeah, and that's because of the gift the market gave us, right? The low interest rates pushed asset prices up, and so then everyone starts saying, all I got to do is get in the game here, and whatever I have is going to be worth more tomorrow. And that, of course, is not the case. And so anybody that jumped on that train is now, trying to figure that out. Trying to figure out, can I restructure my debt? Can I bring in new money? Can I sell? Can I negotiate with the lender? Do I bring in another equity partner? What do I condo? I was on a call with somebody else that said, if I condo these, if I take this apartment building and condo them, I can get more. Everybody's trying to figure out a way not to lose their property. Yeah. In some cases, and that's why I mean by the 10-year. So the 10-year, it was already bad at 3.5, 3.6, and back in September, and now it's in the low 4s. Let's call it. If it just goes back to the way it was, it's from my standpoint, it
doesn't bail these people out.
Doesn't move that much.
Yeah, they're all trying to be Kenny McElroy. The problem, though, is they don't have what makes you great. And that's the 35 years plus of experience in the good markets and the bad markets and everything in between, right?
Yeah, that's exactly right.
There is some value.
Yeah, there is some value to
experience.
I have taken my pain. Trust me. I know what they're going through. Yeah. I hate to see it. But now I'm in a different position. I can, as I like to say, I solved their problem, but and be able to deliver really good value for our investors.
Yeah, that's right. That's right. That's the bottom line. Okay, well, Kenny, I sure appreciate the download. That's I like going through those thought experiments and saying, okay, we've got, let's say, 3 or 4 different options. If this plays out, then what does that mean for residential? What does that mean for multifamily? And I think probably one of the main takeaways from this conversation for people to think through is all of the carnage, let's say, from the less sophisticated or less experienced multifamily people. How does that impact the banks? How does that impact their balance sheet? How does that impact lending going forward? And then if we do see liquidity continue to tighten, what does that mean for the broader economy? I mean, this is, and I don't have the answers. I'm just saying this is the stuff that I think we should really think through. So Kenny, how can people find out more about what you do?
Oh, thanks, George. Yeah, just KenMcElroy.com is the greatest place to land. And of course, we have the YouTube and you can see all our deals. Our company is MC Companies. You can just go on and check those out and you can see our deals and see what we bought and own. And we got about 300 people. We're located in Scottsdale and we're buying basically in the Southwest.
Okay, very cool, man. You're going to be at Rebel Capitalist Live.
Oh, yeah. Yeah, I can't wait. That's my favorite event.
Hey guys, I'd like to personally invite each and every one of you to attend this year's Rebel Capitalist Live. This is the incredible conference I put on annually that helps you build a bulletproof portfolio. It helps you increase your personal freedom and liberty, and also it helps you increase the size of your network. In other words, you get to meet a lot of like-minded individuals, fellow Rebel Capitalists. It's in Orlando, May 23rd through the 25th. Past speakers have included people like Robert Kiyosaki, Ron Paul, Peter Schiff, Mike Maloney, Lynn Alden, just to name a few. So to get your tickets ASAP and to find out who is speaking at this year's Rebel Capitalist Live, you can check it out at rebelcapitalistlive.com. And just a little quick insider information, if you get your tickets sooner than later, you can get a discount, because as we get closer and closer to the event, the tickets go up in price. So don't wait. Go to rebelcapitalistlive.com right now and get your tickets. And I will see you in Orlando, May 23rd through the 25th.